Okay, today's Cardinal Lesson, tax planning, 2026 tax planning and the 7 worries. So all the numbers are out for 2026, and the IRS doesn't make laws. They simply enforce laws. Congress makes laws, and these things automatically reset all the tax rates, all the charts, all the brackets, all the numbers get an inflationary reset done by the government, and then they come out, and so here they are, and so we're going to use them as an opportunity to we use this in tax planning. Okay, so we're going to go through the 7 worries: Social Security, Medicare, long-term care, IRA, 401k, income planning, estate planning, and tax planning. And we're going to apply how does tax planning affect each one of these. That's what's going on in here. And I want to put it to Tom, and I want Tom to share, like, why is this important enough to do a video on, Tom?
Yeah, I mean, we're doing this video because taxes touch everything in your life. They touch everything in retirement. And it even becomes more important in retirement because you have a finite amount of money that you've saved up. And we need to pay as little tax as possible over the life of that money. So you get to keep it. You get to do the stuff you want to do in retirement. And so it's important that we focus on this, that we plan for it. We talk about it in a lot of our other shows. It's not the main priority, right? We want to make sure we're hitting our other goals, but we need to have a view towards the taxes on all this stuff. So we just want to walk through today, show you how it impacts all sort of the 7 areas that we go over. So let me bring up the show notes. You can find these below the link of our video. They're also on our website, cardinalguide.com. We have the board as always. And there's actually a pretty helpful chart. I'm not going to spend a lot of time in here because there's a lot of information. We're going to go through the board. But if you want to print this out and you sort of look at the area that you're focused on, a lot of really good information on this chart with a lot of numbers and stuff. So again, as we go through the show, we'll reference a lot of this stuff in here on your own. If you want to print it out and study it a little bit closer, by all means, go for it. And then if you have questions, reach out and call us. So let me turn it back to Hans, and we'll just sort of go piece by piece on the board here.
Okay, so we're going to start right in worry number 7, taxes, income taxes and tax planning. And we're going to say, here are the brackets. Here's the percentages. Here's the tax thing. And this is where people find themselves in our videos, is generally when we put up these numbers, these are the numbers for 2026, is the first thing people do is look there. And this proved true with our producer this morning, comes and says, okay, help me out here. Which chart am I on? And then, he could obviously figure out he was in married filing joint. And he said, what's this business with the 24,000? What's this number 24, less than 24? I said, okay, that's less than 24,000 of income. So if you're between 0 and 24,000 of income, you're married filing joint, you're paying 10% federal taxes. Okay. And he said, well, that's a pretty low amount. Well, wait a minute. If you're married filing jointly, you're both over 65, you've got a standard deduction of 35,500. And then in addition to that, you have a senior deduction of $12,000. That's providing your joint income is less than 150,000. So, and obviously we're talking about somebody at 24,000. So before we start getting at this number, we got to take $47,000 in deductions. So if we were right at the top of this at 24,000, we'd actually have 72,000 of income, of taxable income, before we'd be at $24,000 where we'd pay the 10% rate. So there's a lot of deductions built into this stuff before we get pressed down to this number. And furthermore, if this married couple is collecting another 3,000 or 4,000 a month, or $40,000 to $50,000 a year in Social Security, which is going to be partially taxable. So you can see that retired people are not going to pay taxes at really high rates unless they have a whole lot of income. So, this is just going through and looking at the charts, finding yourself in the chart. And if you're single, I mean, the same thing is less up to $12,000, you're paying 10% tax rates, but you've got an $18,150 standard deduction. And then if you're less than 75 grand of taxable income, you got that senior deduction coming in at 6,000. So, you're going to take a lot of stuff off before you start paying taxes at these rates. So this stuff is important to just understand. And it's certainly important for us to understand it when we're doing tax planning, because we can make decisions and of where you're going to be each year and what tax bracket you're going to be in and really how much tax you're going to pay. So I want to push it to Tom. And Tom?
Yeah, I mean, I think this bottom right section of the board here, this is probably one of the more important charts we have on the whole board because this is your tax brackets, right? All taxable income is going to fall within these brackets. Again, there's some exceptions, capital gains and stuff are on a different schedule, but essentially your income is on these brackets here, and you need to know kind of what bracket you're falling in to see if there's room to do some planning like Roth conversions or other things like that. Another thing that's commonly misunderstood is you get to fill up those lower brackets, right? So let's say if we look at the chart and you're a married couple, or maybe we'll do a single example. You're a single tax filer and you have $150,000 of taxable income. So after the deductions and everything, your taxable income is $150,000. You go look at the board, that puts you in the 24% tax bracket. So a lot of people just assume, oh, I pay 24% tax on all my money. And that's sort of their mental math they're doing. So I need this much to gross to net the money I need to live off of. But it's just not true, right? I mean, you get to fill up those lower brackets first. So some of your money is being taxed at 10%, some's at 12, some's at 22. So really what you want to look at is your effective tax rate, not necessarily your marginal tax bracket when it comes down to sort of cash flow planning, how much we actually need out of the accounts. And again, we're not going to get into that today because that would be a whole nother video. But it's just important to understand how the brackets work, because when you're trying to get your income and we're wanting to do some planning around this or see how much you need gross to net what your spendable money is, you kind of need to know what your effective rate is, which is more important than what the actual marginal rate that whatever bracket you're in there. So I point that out because it's something that's often misunderstood. When we go to the next section on the board, so we're sort of going to go backwards on the board. We're going to go to estate planning next. And so there's a estate tax in the tax law. Now, granted, the exemption for 2026 is $15 million per person. So if you have a couple, that's a estate worth $30 million or more is taxed at the estate tax. So not a lot of people fall into that. If you are in that scenario, that's still something you need to worry about. But again, for the vast majority of people, that's not something they have to worry about too much. But really where the hidden estate tax is, what a lot of people face, is the income tax owed on the IRA and the 401k money, or traditional IRAs as well, because that money is still needing to be taxed when it gets passed on to the next generation. And again, within the Secure Act that got passed several years ago, they've accelerated the distribution schedule on that. So now they have, if you leave this to your child, for example, they have 10 years that they have to deplete that account. So if the IRA is really sort of your legacy plan, which is what most people default is they don't really spend it. They maybe are taking the minimum out. They don't really need it. And say, oh, this money is just going to go to my kids, which is great, right? I like that you're thinking about trying to pass money on to the next generation and everything like that. The problem is you're leaving them a tax bomb, right? You're leaving them an account that potentially could drive up their taxes into much higher rates. So you've spent your whole life keeping your taxes low, managing the tax rates, thinking you're doing a great job, just to leave it to them for them to withdraw it and have to pay a lot back in taxes. So again, that's generally not the most efficient way. And you need to think through from a planning standpoint. So how the taxes relate to that is you need to, if you're over 15 million per person, estate tax, certainly we need to think about that. Because again, the estate tax is 40%. The worst case scenario is you're over that 15 million and a bunch of that money is in an IRA. Now it's getting taxed twice. You have income taxes owed and estate taxes owed. So that's a really bad scenario. So again, a lot of it is interrelated here. You need to think through how that works. One other point on the estate tax, and then I'll pass it to Hans here, is there is an annual exclusion that you can give away without having to account for it anywhere. For 2026, and I think it's also the same for 2025, that's $19,000 per person that you can give per person per recipient. So if it's me and my wife giving it to someone, I could give 19, my wife could give 19. So you can start stacking this up to give quite a lot of money away. And it doesn't need to be reported. It's not accounted for. It doesn't count towards your lifetime exclusion. One thing I see misunderstood again, people make mistakes here, is they think they can only give $19,000 away, which that is the annual exclusion. You don't have to account for it anywhere. You can give above 19 if you want to. Like if you're trying to help your child with a down payment on a home, or something like that. And the only difference is if you give above the annual exclusion, you now just have to account for it. No taxes are owed, so no one's paying any taxes. It just goes against your lifetime exclusion of what currently is $15 million. So you can give quite a lot of money away, still pay no taxes. You just might have to account for it if you're above the 19. So Hans, I don't know if you have anything else to say on that.
Yeah, I mean, this is the estate tax, is the IRA transfer at death, um, the modern estate tax. In other words, the thresholds have gotten so high that you need to be very well to do before the estate tax is an issue. So the estate tax has become the taxes due by the next generation on the IRA money. Yeah, I just tell you that I help people, the beneficiaries, with a lot of our clients is just after somebody passes away, so you're the beneficiary, and people say, how much am I receiving? And, when I've got a couple, people have a couple children, two beneficiaries, identical amounts, usually one kid is going to do the smart thing and they're going to listen to us. They're going to spread it out over the 10 years, not wait till the end of the 10 years. But the other kid is going to get, how much can I get now? And they may not ask that directly, but through their actions is, how much am I getting? Well, 263,000. Okay. And, it's kind of like, I'll take a check. Well, hold on a minute, is if we give you a check for that all now, we're going to have to withhold like $100,000 in taxes. What do you mean? What do I get? 163? Yeah. Okay. I'll take a check. I mean, that's going to be one of the kids out of the lot. That's the only way they can get at the money is to pay the taxes all in 1 year. It's drive them into a ridiculously high tax bracket. And just want you to think about that with estate planning. There's some things you can do to prevent that or to lessen the impact on the next generation. So, next subject, income planning, investment planning is how to taxes. What's the role of taxes? Well, for one thing, is when we have non-qualified money that's not in an IRA, and we're paying income taxes, we're not going to have to pay any capital gains tax until we sell the underlying asset. So that's just, and when we pay the capital gains taxes, they're going to be at a smaller rate than the ordinary income taxes. So that's something to note. And then this qualifies on qualified dividends. So just understand that not IRA money can be planned in such a way to have lower tax rates that can be timed with the use of the money. And then, the old choose your tax bracket is when we're getting into, when you need income, you need it every year. So when we're doing income planning, we got to plan that for the rest of your life for you and your spouse. And we got to plan it for how much your spouse or you are going to need when your spouse died, so that the survivor planning for the rest of their life. But it's going to kind of be the same amount of income adjusted for inflation every year. Works very well with tax planning, because the tax planning is going to spread out the distributions of that IRA over your lifetime. So this is very important with income planning. And then just added to that, you can't spend tax money. So when we have people come to us and say, what do you need to live? Well, we need $8,000 a month. And I say, is that before taxes or after taxes? Well, I hadn't thought about that yet. Well, we better think about it, because we build our financial plans based upon what you get to keep. We're going to start there, and then we're going to build the plan up from there and then adjust that for inflation. Tom?
Yeah, I mean, at the end of the day, the less you have to pay in taxes is the more you get to keep. And so it's an important thing to think about from an income and an investment standpoint. If you have a mix of money, like some in non-qualified accounts, money that's already been taxed, and then some in what's called qualified accounts or IRAs, money that hasn't been taxed yet, you can pick and choose what you sell, when you sell it, how to generate the income. One of the things that I want you to consider, though, is sometimes people get so focused on the year they're in, minimizing the taxes this year, is they sort of miss the big picture, right? Is we want to look at sort of your lifetime tax bill. So you could do a great job of keeping your income really, really low up until RMDs start. And if you have a large IRA, those RMDs are going to kick in, and that's going to drive up your taxes. So again, we want to prevent big spikes in income. A lot of times that means smoothing out the taxes, which could mean pulling money out, intentionally paying more taxes now to avoid higher taxes in the future. So again, it's a long-term proposition, not necessarily each individual year are we trying to minimize the tax in that year. This is related to sort of the next section on the board, the IRA and the 401k. Ultimately, these are accounts that, and specifically talking about traditional IRA and traditional 401k money, that haven't been taxed yet, right? So this money, you might look at your statement and it's grown to $1 million, right? You maybe never thought you were going to have near that amount of money, and you're really happy about it, which is great. You've been a great saver, but not all of that money is yours, right? Some of that money is going to get spent on taxes. And so the goal is to try to minimize that, pick when you pay it. And again, the goal here is to sort of minimize the IRS as your silent partner, if you will, in this account. And we want to pay them off at the least amount possible over time. So again, not to burst your bubble, but not all of the money in the IRA or 401k is yours. Some of it's going to get paid in taxes. Our goal is just to pay the least amount possible to the IRS over that time. The numbers we have here on the board really talk about sort of how much you can add into the account. So if you're still working, how much money can you contribute to the IRA and 401k? And so again, if you're still working, maybe you have high income and you want to defer the taxes out of that high income, high tax bracket into maybe a lower tax bracket when you pull it out in the future. Again, that's not a blanket recommendation. Everyone's situation is different. We would need to look at your specific needs and goals to determine whether Roth or traditional is better. But at the end of the day, you're allowed to contribute, if you're over 50, into a 401k, $32,500. For an IRA, it's $8,600, again, if you're over 50 years old, which is most of our audience. And so just know that those are the limits. The 401k, there's some even higher limits if you have sort of in your 60s, right before retirement. I don't want to get into that today. But you can add quite a lot of money in savings. Ultimately, if you have children that are just starting out working, certainly encourage them to be saving here. This automatic saving out of the paychecks is really how they're going to set themselves up to be, financially stable, have a nice retirement. By starting young and consistently investing over time is how they're going to grow those accounts up there. And then we also have on the board this QCD limit. So again, if you're over 70 and a half, you can give money directly out of an IRA to a charity, and that money actually never got taxed, right? It went into the traditional IRA or 401k. You got a tax deduction then. It's grown tax deferred, meaning you haven't had to pay any taxes on the growth of that account, and you get to send it to a charity tax free. So this is a wonderful way if you're going to do giving, if you're charitably inclined. Once you hit 70 and a half, this is a wonderful way to do the giving. The maximum amount you can do in 2026 is $111,000. So just know that. If you have questions about that, we have other videos on that, and you can give us a call. We'll help walk you through that.
Yeah, a lot of people that come into us, they're still working. Maybe they haven't retired yet, or one of them's still working, and one of them's retired or retiring. But and so then they want to find out about Roth conversions. Well, let's start out with the fact: are you contributing the maximum that you can to your 401k? Are you putting in the whole $32,500, which is the amount over 50? And if you're not, can you afford to? And most likely you can if you're that close to retirement that you're coming to us to plan it all out. So that's the first place we're going to take you. And then are you contributing through the Roth portion of your 401k? Because if you're looking at Roth conversions, this might be the easiest place to do it, is in your contributions, just contribute to the Roth. So that's for the people still working, or one of them still working. The second thing is for those of you that still have some work income. Maybe you've retired, but you got a part-time job somewhere, you have a small business that you run, and you can put $8,600 in an IRA. Okay, and if you have a small business, we can do that through the small business. But then you're going to say, wait a minute, I can't contribute to an IRA because I got too much income to meet those thresholds. Well, maybe you can. There's such a thing as a backdoor Roth IRA. I'm not going to get into that. I've done other videos on that, but you can put $8,600 in your own IRA, and then you can put $8,600 in an IRA for your spouse, even if your spouse isn't working, as long as you have $8,600 in work income. So we'll get into that in another show. This is very relevant to tax planning, because that's what IRA contributions and build up and conversions and all that kind of stuff are all about, taxes. So next section, we're going to just talk about long-term care. Yeah, long-term care, separate from taxes, is just something that you really need to consider where you're healthy enough to do something about it, and getting together a long-term care plan. Now I'm going to take it to taxes, because this is something that a lot of people don't think about. The benefits coming out of a long-term care policy are not taxable. So in other words, you can have up to $430 a day of benefits coming out of a long-term care. So that means you're collecting on it. You're getting home health care, or you're in an assisted living and you're collecting. That's over $12,000 a month that you can collect out of a long-term care policy and not pay any taxes on it. So how does that matter? Well, if you're one of these people that say, I'll just pay for it myself if that happens to me, I've got a lot of money. Well, you're going to be paying for that out of after-tax money. And there's some ways we can deduct it, but just understand there's a real benefit to tax planning when it applies to this area of long-term care planning. Tom?
Yeah, I mean the long-term care, the tax portion of it, I mean, as it relates to the video, is the benefits being tax-free is wonderful, right? I mean, there's many reasons that we think long-term care insurance is something you should consider. But from a tax standpoint, it's nice that when you need that money in the future, you're needing care, you're not having to worry about not having to pull more out to pay the taxes to get the net amount to pay for the care. Whereas if you had, if people come in and say, oh, I have enough, I will self-insure, which could be true, right? They might have enough, they can do that. The question becomes how much taxes, which accounts are you pulling it from? And you're not going to be in the position to make that call, right? It's typically your children, it's your spouse who maybe isn't involved that's having to figure out what to do about that. So the long-term care insurance is a wonderful way to do that. There are some small situations where you can actually take a deduction on the premium for the long-term care. Not many, when you get into all the sort of logistics of how you can do it, not many people are able to take advantage of that. If you own a business, especially a C Corp, now we can really start talking about deducting a lot of premiums. So I don't want to get into that today, but if you do own a business and are interested in long-term care, give us a call, because there's a lot of ways you can write off a lot of that long-term care premium. So we're going to switch to the next one, which is Medicare. You might say, well, what do taxes have to do with Medicare? Well, there are a couple of ways. One, that's how the Medicare program is funded, right? It's through payroll taxes. So if you're still working, if you look at your check, you have some amount of money coming out of that paycheck to pay the Medicare premium. So that's a part of it. Almost more importantly, what's more frustrating for a lot of people is when you finally get to Medicare, you finally retire, you say, finally, I got here, I've paid in all these years, let me see what this is all about. And you get a nice letter from Medicare saying, oh, by the way, based on your income, we're going to charge you more for Medicare. This is called IRMAA, Income Related Monthly Adjustment Amount. And this is something that is quite frustrating, especially when people don't know it's coming. And how it works is they look at your income from 2 years ago. So if you're retiring in 2026, they're going to look at your 2024 income, which presumably you would have still been working. So your income likely was higher then than it will be in the upcoming year. They say, based off that, we're going to charge you more for Medicare. I can't tell you the amount of people who've maybe had millions of dollars, right? It's not about the money. It's sort of about the principle of it. And they just come in quite upset about it, really frustrated because they didn't know it was coming. They maybe did things 2 years ago, like Roth conversions, selling property, doing stuff like that, that they had no idea that there would be an impact on their Medicare premium. So that's why we talk about it so much in these videos, really just to let you know that it exists, that it's coming. Your goal doesn't necessarily need to be to avoid it at all costs. Sometimes it's worth paying some IRMAA to do some other planning. But when we do it, we want to know sort of what we're signing up for, that we're doing it intentionally, that we know what the repercussions of our actions are now and how that will affect the cost 2 years from now. The chart we have here and what's in the show notes really shows you the different brackets of IRMAA, because it's not all or nothing, right? It's sort of phased in. So if you're a married couple and you're below 218,000 again in 2024, and the number they use for that is what they called modified adjusted gross income. So again, they all come up with all this crazy stuff, but they take your adjusted gross income, add back in any tax exempt interest, which would primarily be from municipal bonds. They put those two numbers together, That's how they come up with your MAGI, modified adjusted gross income. And if that's below 218, you don't pay any extra for Medicare. You're at the normal price, nothing to worry about. If you're above 218, now we get into these brackets. And then, again, this is a married couple I'm talking about. You can look at the chart, you can see where you fall, what that actual price would be for Medicare. And then the numbers we have on the board are the annual cost per person for Medicare plus the extra IRMAA expense there. If you have questions about that, we have other videos. You can give us a call. So again, the taxes are important because essentially it's an extra tax on high earners to help fund the Medicare program. So Hans, I don't know if you have anything else to comment on that.
Well, I do. I mean, this is what people pay. 92% of the people that are on Medicare pay the $2,400 a year for Medicare Part B. Okay, that's the cost. Now, if you have a high income, or you had a high income 2 years ago, and you can't do anything about that now, like in 2026, you're paying IRMAA based on your 2024 income. You pay this extra amount. And when people get up into these, they have a high income, and some people that aren't paying it say, well, they make a lot of money and they can afford it. Well, sure they can. But I'm telling you, that's some jack. Is $87.90 per person per year. So we got it's $100,000 a year. You're paying, excuse me, it's not $100,000 a year. It's $87.90 a year per person. But for two people, it's 17, 18, 19 grand a year for your Medicare. And so it's something worth planning around if there's some ways we can juggle your income, or if we're doing a bunch of Roth conversions, creating that, we can plan for this. But it's significant, and it's taxation to people receiving Medicare, and it's all part of the whole financial plan that we're going to take into account for people.
I'm going to make one more point on the IRMAA, and then we'll do the Social Security piece. Is if you retire in this year, you're signing up for Medicare, and your income was higher in 2024, but it's going to be less now. You are able to appeal this IRMAA charge, right? So if you have lower income and you have a life-changing event, and there's specified life-changing events that qualify, you can appeal this, get that number back down. When you file the appeal, you need to estimate what your income is for 2026. You want to estimate accurately, because if you underestimate it and your income ends up being higher, they might approve the appeal now. And then when you finally file your 2024 tax return, they're going to come back and say, oh, by the way, you told us one thing, it was actually higher. We're going to go back and charge you for that extra amount. So when you're filing the appeal, make sure you're accurately putting down what your income is projected for that year. Assuming you do that, you should be able to at least reduce the IRMAA. Maybe not get rid of it completely, again, depending on your income. But if you're in one bracket and we can get to a lower bracket, again, if we can save you more money, that's more money in your pocket that you can go live off of and do stuff you want.
Call Tom or me. We can do a Zoom if you're appealing this thing, and we think about all that stuff and try to anticipate it. Last one we're talking about here is Social Security. How do taxes affect? I mean, it's obvious how Social Security affects retirement planning, but how do taxes on your Social Security affect retirement planning? And we're going to start out. Generally, people that are in the $100,000 to $150,000 a year department, maybe even a little less than that, they tend to overestimate the amount of taxes they're going to pay on Social Security based on reading Social Security's formula. But your Social Security is either going to be taxed at 0%, 50%, or 85%, or somewhere in between. But it's those three numbers kind of stick out. So people that have very little other income besides Social Security, they're paying nothing on their tax on their Social Security. People that have some income, not a lot of income, but it still has some significance to it, plus their Social Security they're living off, they're going to pay some taxes on their Social Security. And people that have a very high income of other income, they're going to pay no more than 85% of their Social Security is taxable. So in other words, that means 15% is tax-free. We have other videos about that, and within your plan, we're going to take this into account. For 2026, the maximum that you're going to pay Social Security taxes on is $184,500 in a year. So in other words, somebody that makes more than that, when they hit 184.5 for the year, they're going to stop taking out the 6.2% for Social Security. And that's kind of a treat to some people that, they're going to finish the year without that Social Security taken out. But that is the maximum that Social Security is insuring. So it makes sense that once you've paid in at the maximum, you're not going to pay any more taxes because this is the income that they're insuring. And if somebody who has made the maximum for 35 years or more, their Social Security at full retirement is going to be $4,152 a month. That's the projection in 2026. And when I was say 30, that number was about 40,000 a year. So if I made 40,000, which I did at that age, I made more than that. That goes down as a year that I made the maximum wage base. And then in my more recent years, I've got to exceed this. All of that collectively for 35 years creates that. Well, why does that matter? Well, this matters a lot to people when they're, on Social Security, is that by paying taxes, payroll taxes, and my employer paying them, I've created this Social Security check. And now that I'm in retirement, the government is potentially going to tax this to the extent of my other income. And so this all gets a bunch of moving targets. It all matters. Tom?
Yeah, I mean, I think Social Security, again, tax similar to Medicare, is taxes impact both sides of the equation, right? Money going in, that's how the program is funded, right? Through payroll taxes. That's where that wage base, the 184,000, come in. And then also potentially on the back end, right? If you have a high income, you have to pay some back end taxes through the formula they use. And we have other videos where we walk through sort of how they calculate it. But it's up to 85% of that of the check is taxable income. Some people hear that and say, I got to pay 85% of my check back in taxes. No, that's not how that works. So up to 85% of your check is taxable income. And now we go to that bottom right corner of the page that gets added to your other income. And you find the tax brackets you're in, and that's how much tax you have to pay. So again, it's a little bit confusing, but that's how that works. And then the other number we have on the board, the 24,480, if you file for Social Security prior to your full retirement age, so anyone born 1960 and after, that's age 67 is your full retirement age. If you file before then, and you're still working, you can only earn up to $24,000, just under $25,000 a year before they start withholding some of that check. So if I get to somebody who's 62, maybe they're making $100,000 a year, and they've heard Social Security's ending, I'm going to go ahead and file now. They file for their benefits. Pretty good chance they get none of that check. They filed for age 62 benefits. They've permanently reduced that check, and they don't get any of it because of this max earnings test that they have if you're under your full retirement age. So if you're considering filing, be really cautious if you're still working. If you're not working, you don't need to worry about this. And that's only work income. So that doesn't have to be IRA distributions. Pensions don't count to that. It's for income from a job is what drives that 24,000 number. So again, if you're thinking about that, call us. We can help you determine whether it's smart, whether it's not, and we'll figure out the best strategy for you.
We put together a financial plan for you. We're going to take all 7 of these subjects, and obviously taxes is going to be a piece of that. We're going to start with your Social Security check, build a plan from there. Medicare is huge to people that are retired, 65 and older. It's their health insurance, making good decisions. And, this IRMAA thing for the high income people, it's something we can plan around or plan for if it's inevitable. That means you make a lot of money, but then we got to plan the taxes on the lot of money is probably more important than actually the IRMAA bill. Long-term care, that has a tax effect really in terms of receiving the benefits tax-free. 401k, IRA, well, that's all about, they were created to save money on taxes and prepare for retirement. Government gives you a tax break all your life so that you build up this fund for retirement, but they're going to get you on the taxes in retirement, and some real sound planning is called for there and how you're going to distribute that. Income planning is really what people come to us for, is I got a how can I take my Social Security and my savings and then my retirement savings and make that last the rest of my life? And how can I manage the tax bill throughout that? Estate planning is what's going to happen to my estate when it transfers to my surviving spouse and then to my kids. What kind of tax, how can I set things up so it'll be the most favorable tax-wise for all parties concerned? And then, obviously income taxes is the place that people try to take us first. Some people, when they come in, this is all they want to talk about. That's why I put it last. I'm going to require them to talk about all this other stuff before we get to the taxes. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.